Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Steve Hanke, the professor of applied economics at the Johns Hopkins University. How you doing today, Professor Steve?
Yeah, doing great, Darrell. How about you?
Man, any day above ground is a blessing, man. So, I'm just trying to live it one day at a time, right?
Yeah, you and me both.
Yeah, yeah. So, I want to start with your perspective on gold. So the gold market has had a lot of volatility lately, and for those of us that hold gold as money, typically the day-to-day moves don't really phase us, but being at the Vancouver Resource Investment Conference here this past week, there was a lot of new investors in the space, a lot of people that were new to buying gold and such. And so they may be more concerned with the recent volatility and such. And so just want to get your perspective on the gold market as a whole and how are you processing the recent volatility?
Okay, so let's go back finally I was on a program in September 22nd actually. The gold was about 3,800 an ounce at that time. And they pressed me on where I thought the bull market was going to peak out, and I said $6,000 an ounce. Uh, and at that time, that was high on the high side. Since then, actually, I've made a range, 6,000 to 7,000. That's where I think it's going. And why did I do that? When I first made my calculation back in September, the number I had at the end of my pencil was 6,600, and I thought, boy, that's pretty high, and people are going to be spooked. I'll round it down to 6,000 rather than rounding it up to 7,000. And subsequently, uh, I've put that range at 6,000, 7,000. So that's one thing. And then we had the very strong market, and then a crash, and it crashed last what Friday.
Yeah,
I
yeah,
can't remember exactly the day, but at any rate, the bottom line is I haven't changed my mind at all. I haven't the fundamentals haven't changed, and everybody's gotten all excited about it. But gold is up about $500 an ounce in the last month
yeah.
after the crash.
Hmm.
So 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 you got to put things into perspective. Now the crash, it's not quite clear exactly what was going on, but usually these things view them in the context of this bull market as a positive thing because all the weak hands, all the novices get washed out, and the market ends up in stronger hands. So the bull actually is stronger.
Hmm.
And you've had this huge speculative frenzy, with in silver even more than gold, with things going up, on steroids. Well, you got a lot of retail investors, new people who really don't know what they're doing exactly, into the market, and they get washed out when these corrections occur.
Yeah.
So that's my take. I think the market's in better shape now than it was before the shall we say the consolidation. Rather
Hmm.
than, I don't want to use the word crash. That sounds kind of extreme, but that's
Yeah.
so that's my take. I'm very relaxed, and I thought the correction or consolidation, whatever you want to call it, was probably a healthy thing because the market really had gotten way out in front of its skis.
Yeah, it did. It did. I was telling some people gold moving. I think it was at the high. It was up almost $1,200 on the month. I think it was like $1,162 or something like that before the correction. And I told people like this is not normal for a move in gold. And so I mean, we haven't seen gold move up $1,000 in the span of a month. I don't know if we've ever seen that. And so that was something that I was telling people that I was engaging with. I'm curious what your target of 6,000 to 7,000. So obviously in every bull market, we do have this blow off top. And so that's probably the concern of some people of like, okay, is this the blow off top? And then now gold's going to consolidate at a floor somewhere. I think the last cycle, it blew off from 1,900 an ounce, and then it had a floor of like 1,100 an ounce or 1,000 or something like that before it started rising again. So are you seeing like 6 to 7,000 as this is the height before like a consolidation?
That's the peak of the bull, secular bull. The way I did that, I looked at what was going on with the 1979-80 bull run and where the price was relative to GDP per capita and in the United States, and just with those ratios, the same ones, and the increase that we've had in GDP per capita, just running those numbers with the same ratios and say, fine, that was a huge bull run in 1979, 1980, and
Mhm.
I just worked the pencil and on a piece of paper, and bang, you get a number, and it was 6,600, and now let's have that range 6,000 to 7,000. So it didn't make any assumptions about a war, inflation, and anything like that. It's just the relationship between the price of gold and uh, GDP per capita.
hmm Okay, and how do you factor in M2 money supply into that model?
It isn't really, it's factored in a way because you've had GDP per capita increasing since 1980. And one reason for that increase, you have two factors coming into the play. You've got real GDP going up, and then you've got inflation, and add them together, and you've got nominal. Or you could make the calculation in real terms, but we're in a nominal world. So
hmm
it's a nominal world. We got to add inflation in, and inflation is always and everywhere a monetary phenomenon. So M2 comes in indirectly because that's what drives inflation. Over the long run, the changes in M2 will match the changes in inflation.
Gotcha. Yeah, that makes sense.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Silver. I'm curious in your perspective on silver. Silver obviously had a parabolic move upwards. It corrected significantly. Well, it like crashed pretty much. I think it was what 40% at the high of the crash or whatever. But just curious in your perspective there.
Yeah, yeah. And over the last month, it's about just a little below where it was a month ago right now. So it went up much more rapidly than gold, and the correction was much larger. And I think that is consistent with my view that there were a lot of weak hands, amateurs, first timers jumping in,
hmm
speculators, and they took the exit door, and there were just more of them concentrated in silver than in gold. When the correction came, it was larger because number one, the silver market had gone up more rapidly. And why did it go up more rapidly? I think you had more speculators jumping into the market. I mean, there were even a lot of reports that people were going out of crypto and at the margin anyway, and going into precious metals. This was before when the thing was going up very fast,
hmm
and especially Bitcoin. I mean, Bitcoin is nothing more than a speculative asset with highly speculative asset with zero fundamental value. So
Yeah.
some of those people were migrating over and getting on the silver and gold bandwagon. Well, I think with the correction, they ended up getting off the bandwagon, and there was simply a bigger concentration of them in silver than in gold. That's my intuition.
Yeah. Yeah, it was kind of interesting. I saw, I kind of get this sentiment. I do these sentiment checks on X, and some folks in the crypto community were talking about gold as like, oh, this is supposed to be the safe haven. The metals are down 10 to 40% and such, and they were taunting that. And then I think over that weekend. And over this past week, I mean, the crypto market had a huge washout. Like, it's like,
Right.
yeah.
So and to some extent that does feed into, as that washes out, those people, to the extent that they have some of their liquidities in silver and gold, that causes the washout to slop over into the silver and gold markets.
Mm-hmm. Yeah. Yeah, I can see that. Okay, so pivot into sentiment. So yeah, posted a chart recently on consumer confidence chart where that's at a significant low, as well as I think it was the University of Michigan came out with the consumer sentiment study, and that showed consumer sentiment at a significant low. And then we had GDP numbers that came out, and President Trump was kind of taunting them, and you have, the narrative that we're in a strong economy. And so just curious in your perspective on the U.S. economy right now.
So the starting point is that the potential growth rate in the U.S. economy on a sustained basis for a long period of time is around 2.5%. And it fluctuates, obviously, around that potential, sometimes a little higher, sometimes a little lower. And just to give you the numbers, Darrell, 2022, the growth was right on 2.5%, right on the potential. 23 went up a little over the potential, 2.9%. 24, 2.8%. And now the consensus forecast for 25, actually, we don't have the last quarter's worth of data, but the consensus for the year is 1.8 to 2.3. However, let's look at the quarters for 2025. The first quarter was actually a negative 0.6%. We actually had a negative number for the first quarter. Then it bounced up to the second quarter 3.8, and the one you were talking about that Trump was trumpeting, it was the third quarter recently came in 4.4. And if you look at the Atlanta Fed now forecast for the fourth quarter, they come in at 4.2. So the yearly rate will probably come in on the high side of the consensus. The high end of the consensus for 25 is 2.3. Now the question is, well, what about 2? That's we're waiting for those 2025 data to arrive and come in for a number. We don't have the final number yet for 2025, but 26. The Congressional Budget Office forecast is 2.2. The Fed is 2.3. And Goldman Sachs is a little more optimistic. They're 2.8. So what do those numbers tell you? And some more numbers, by the way. If we look 2025 to 2030, the IMF has a long-range forecast of 2. Mm. And if you listen to the Secretary of Commerce Lutnick in Davos, he was saying 5 to 6. That's a Trump administration. So what you're getting at here is there's a lot of hype coming from the Trump administration, and to some extent, I would say the Silicon Valley crowd, the AI crowd. AI is going to change the world, and productivity is going to boom, the economy is going to boom, and that structure of the economy will change. They claim it'll go up way above 2.5. Remember, 2.5 is kind of the benchmark, the base case, if you will, the potential for the economy. That's where it's been running for quite some time. But the AI crowd and the Silicon Valley crowd and the Trumpists, the Make America Great Again crowd, they have much higher potential. But I'm very skeptical of that. These things don't change around that much.
Mm-hmm.
So, and if you look, even with Goldman Sachs, which is, as I say, on the optimistic side, they're at 2.8 for 2026. Well, 2.8 is what we had in 2024, and we had 2.9 in 23. That's so nothing has changed much. The point is there's a tremendous amount of hype out there. And by the way, when the market was down a couple of days ago, the stock market was down, and it was down. Why? The reporting was, well, people were getting nervous about the growth rate, that maybe it wasn't going to be as high as the hype, and so the market went down. Now today the market's up. I think so. So at any rate, once you get into this GDP zone, I think the number that Goldman has is fine. I mean, it's an optimistic number, but it's kind of in the zone, and it's not in this hype zone. The hype zone is like 5, 6. That's what's coming out of Secretary of Commerce Lutton.
That's alternative reality or something.
Yeah, right. So I think even though we have had 3 very strong quarters in a row, assuming that now forecast from the Atlanta Fed of 4.2% in the fourth quarter, we've had second quarter 3.8, third quarter 4.4. The now forecast for the fourth quarter is 4.2. So it looks very strong, like on the strong end. But remember, we had a negative first quarter in 2025, so the whole thing is going to be brought down much the year over year. But by the time it comes in, the year over year is going to be lower. So, so at any rate, that's my take. I'm not in the hype camp.
Yeah. Got it.
I'm more or less in the Goldman camp.
Okay.
Which is pretty much running what things have been running 23, 24, 25. And it's pretty close and in the zone of the potential growth rate in the economy. If you go double the potential, let's say the potential is 2.5, that's a number we know about, and somebody tells you, oh, we're going to have 5 or 6% growth, that's twice as fast as the potential. So you got to say, well, you got to look under the hood and say, well, what's going on? What's the basis for 5 to 6%? And I just don't think it's there.
Yeah. So with these consumer sentiment numbers, consumer confidence numbers, I actually did just an on stage experience at the conference this year, and I just asked who thinks we're in a strong economy. Hardly anybody rose their hands. Many people felt like the economy was weak. And granted, these are people from all over the world, and so I just been kind of trying to pinpoint. I mean, the only explanation that I understand, to my understanding, is that the Wall Street economy and the Main Street economy are two separate things, and they're having two separate experiences. We have the K-shaped economy and such, because when I'm talking to people, on a day to day, people seem to they're not very optimistic about the economy and such. And so, whenever the Trump administration does come out and bring these high hype numbers out, it's like, yeah, I don't think that's being I think that's being a disservice to the people.
Well, you kind of put your finger on the thing, Darrell. There is kind of a bifurcated thing. You call it K economy, on the top side of the K, and then the bottom side, and you have, in fact, what's going on, what's driving GDP. These numbers, by the way, is pretty hot consumption. Remember, GDP is what? It's consumption plus investment plus government spending, uh, plus the international account. And consumption takes up about 2/3 of GDP. So the thing that really always drives it hard is consumption. Now, who's consuming? The top 20% of earners are making up about 60% of all consumption. So you have very few people at the top that have benefited from the boom in the stock market since 2020. There's no question about that. And you get this huge positive wealth effect. Their net worth has gone up a lot, and so they spend a lot. 20% of the top earners accounting for 60% of all the consumption. Now, below the top 20%, you've got the other 80%. You've got a huge number of people that have not benefited to the extent that the top have, and some of them have gone backwards as you go down the ladder. Their wage at the bottom end, their wages haven't kept up with inflation, so their real inflation adjusted position is actually weaker than it was in 2020, 5 years ago. So you get a lot of grumbling, and if you look at the polling data, most people are negative on Trump. The majority. I'm not. Again, it's the numbers are coming from the bottom end of the K. So they're negative. His polling numbers keep going down, 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 and that's a lot different picture than the GDP. Those big numbers that we got. You have to ask the question, Darrell. Why is he getting negative ratings when the third quarter number came out for GDP and it was 4.4% year over year? And this is why. What I'm telling you is why. You have a relatively small number of people that have made out like bandits in the stock market, and they are driving consumption. And that consumption drives GDP. So the GDP thing, the top line thing looks pretty good. And you say, why are people negative on the economy? Well, you have all those people below the median, or the average. You have all those people, a lot of numbers, and they are the ones that are in this affordability problem. There's a lot of talk about affordability, and there's a lot of talk also about prices. The price, the CPI price index is still 2.7%. That the target rate is 2%. 2.7 is a lot greater than 2. And my view is that the inflation genie will not be put back in the bottle because the money supply started to accelerate again.
Mm-hmm.
So at any rate, I think the affordability issue is a real issue, and the inflation issue is a real issue, and that actually isn't the Achilles heel of the Trump administration. He can talk about the strong numbers we've had in the third quarter, and we'll get probably a strong fourth quarter report for 2025, but most of the people that's kind of irrelevant.
Yeah, for sure. So looking at so you do have this dynamic, and I do think, he came out and he's trying to buy the midterms. I haven't heard much about the credit card interest cap or the purchasing of mortgage-backed securities. for the housing affordability. So one, he was like, okay, we need to get interest rates down so that we can make housing more affordable. But then in another video, he says, oh, the homeowners, we're not trying to, we don't want to decrease their home values and such. And so it's kind of like, okay, which one is it? And so it seems like, there's, there's this initiative to like, okay, the midterms are super important. And, he's trying to, or he's talking, some potential policy moves that could benefit the average people. But, it doesn't seem like much of that is coming to fruition.
Well, yeah, and you talk about the midterms. Even earlier this week, the New York Post, which is a Trumpist newspaper, published a poll indicating that the midterms, the Republicans are going to have a lot of trouble.
Yeah.
And why are they going to have a lot of trouble? One is this affordability and the dissatisfaction with the economy and the low ratings Trump is getting on Trumponomics or whatever you want to call it. So that's one aspect. And another aspect is that I think people are concerned that they don't want to get tangled up in some war or someplace. And so the international scene in terms of war versus peace, that's an issue. Another international thing is that you have all these threats of Trump's tariffs and so forth, and it's clear that you have countries they're pivoting away from the United States. Trump threatens them with tariffs or puts tariffs on them if they don't do what he's asking them to do, and what happens? He's turning friends into enemies, and the friends into enemies. Where are they going? They're going to China and India. Look at Canada.
Yeah.
Canada had real problems with China, by the way. And what happened? Prime Minister Carney went to Beijing a couple of weeks ago and cut a deal with the Chinese, a trade deal. Now, the pivot, that's Canada. The European Union did exactly the same thing in India last week. They signed a trade deal with India. And again, you can't just disassociate with the United States, the biggest economy in the world, but at the margin, everything in economics happens at the margin. At the margin, the pivot is occurring.
Mm-hmm. Yeah.
And the pivot is, in simple terms, the foreigners view the United States as being unfriendly and threatening.
Yeah. That's what I'm gonna explain to my daughters, man. That's the simplest way we can definitely put
it. Absolutely. Some guy points a gun at your head and tells you to sign on the bottom line. Well, in the private world, by the way, signing under duress is the contract wouldn't be valid.
Yeah, for sure.
And so you have the same kind of thing going on, and there's no international law to say that signing under duress is invalid, but you get the picture.
Yeah, for sure.
If you went in to sign a mortgage and some guy had a gun at your head and said, this is the mortgage you're taking out, this is the interest rate you're going to pay, and if you don't sign, I'm pulling the trigger. You could go to court with that immediately, and that would be an invalid contract.
Yeah. They also wouldn't get paid either. So
that's right. So this is in the international sphere. These tariffs are not being used like a traditional economic tool. They call it leverage. We have leverage. We can apply leverage. Well, this is a threat system, in which applying the leverage is equivalent to holding a gun against the guy's head.
Yeah, for sure. I mean, that's a lot to cover. I mean, even with the Supreme Court, they're coming out with their decision at some point. It's speculated it's going to be soon. even I was curious about the Chinese and the news about the world reserve currency and such. But we could cover that at some point. I do want to talk about Kevin Warsh. And I'm curious in your perspective on him. So obviously, Jerome Powell came under fire, with the DOJ, and there was a heated exchange between Jerome Powell and the Trump administration. And then now Kevin Warsh, who was known as a hawk, Fed hawk, and the markets reacted a certain way, which I don't think that was the sole reason why the markets reacted in the sell-off when he was selected. I think that Trump wants what he wants. I mean, he wants to increase the military budget by $500 billion. He wants lower interest rates, and things of that nature. So I don't imagine him nominating someone that wouldn't be in line with his agenda. But just curious in your perspective on Kevin Warsh.
Well, just in terms of what he said publicly, his position has been, and by the way, the Secretary of Treasury, Scott Bessent, essentially has the same position on the size of the balance sheet of the Fed. They have been critical of quantitative easing and the expansion of the balance sheet of the Fed. So let's assume that they want to reduce that. Well, to do that, by the way, that's what the Fed was doing until December. The Fed was engaged in quantitative tightening and shrinking the balance sheet. Then in December, they changed over and started quantitative easing again, and they indicated, and they have done, that they will purchase $40 billion of T-bills, the Fed. Now that increases the size of the balance sheet. Okay, so that's where we are right now. Now let's assume that, given the position of Warsh, that his nomination, he would be confirmed. So let's assume he's been nominated by the president. He will have to be confirmed by the Senate. Mm-hmm. Let's assume that he becomes the Fed chairman and that he wants to follow through on his concern about the size of the Fed's balance sheet. So he'd have to switch gears from where they are right now, quantitative easing, to quantitative tightening again. Now, that might pose a problem, because that assumption, that move would mean that the Fed's contribution to the growth in the money supply, broadly measured by him too, that contribution would be maybe negative. So you think that's going to make Trump very happy?
No, yeah, he might get a DOJ subpoena or something.
So that wouldn't make him very happy. Now, how to get out of this? You actually can find it, because in my recent book I co-authored with Matt Sekurki, Making Money Work, we have worked out how you can shrink the Fed's balance sheet without causing this kind of contraction, unusual contraction in the money supply. We don't want to get out in the weeds that far, Darrell, on this program, but it is laid out in our book how to shrink the Fed's balance sheet without causing problems.
Got it. Yeah, well, yeah, definitely we'll link to that book for people to go check it out. And so appreciate you coming on the show. I mean, a lot to cover, a lot of things happening right now. We definitely got to reach out and try to get you back on the show and everything. You got any other words for the audience where they can connect with you, ask you questions? Or
Well, two ways to do that. The easiest way is to follow me on X, just at Steve_Hanke. And the other way, by the way, is to send me an email, Hanke at jhu.edu, and just say you want to be on my weekly distribution list. So the distribution list is, I include, like, our podcast will be on the distribution, articles I write in Fortune magazine or something like that, or speeches I give, or even more technical papers. So that's on the distribution. I'm just looking. The X following as 826,400 followers. It's the third highest of any economist.
That's a big audience. I got to get you to follow me back on there, man.
Okay, will do.
Well, yeah, I appreciate you, Professor. Go ahead.
Anyway, great to be with you, Darrell. And
yes,
have a great weekend.
Yes, you too. Thank you for providing that insight and sharing that those numbers with us. I mean, that's what we need. We need objective numbers, right?
Absolutely. Nothing beats the data. Let the data talk.
Yep, exactly. Well, thank you, Professor Steve, and audience. Be sure to hit the subscribe button if you haven't subscribed yet, and love to stay connected with you all. Thank you for watching.